Welcome back to Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Today I have again Mike Zuzolo, President of Global Commodity Analytics, and he is going to speak about floods in China that could bring more demand for grain and oilseeds in the United States. Mike, how are you today?
Doing well, Louise. Thanks for having me back.
Yeah, if you are liking our content, please subscribe and click on the bell button and like us. You'll be getting more of our content. So, Mike, these floods in Asia, how do you think they will impact demand?
I sent a special report out to clients earlier this week, Louise, when I saw Reuters report that China's state government was releasing both wheat and rice into out of their state reserves and into their feed livestock sector to help compensate for the sharply higher corn prices that they're dealing with right now. And what struck me most of all was not necessarily the high corn price and the fact that it's almost 3 times higher at the Dalian exchange for their futures versus what we're trading at the mercantile exchange, but the sheer amount of rice that they released. It was 10 million tons, which is a substantial amount when you think about that being such a big food security issue. So I did a lot more investigation and took a look at where their major crop areas were this year. And, this is an area with this Three Gorges Dam and the Yangtze River and its tributaries right in the heart of rice country and rice and wheat production. I would say 50% or more of their rice production is right in this area that's being flooded. Some of the Asian sources that I have, both in Taiwan, in Singapore, and also other YouTubers in China proper, are suggesting that we have seen the record amount of rainfall in the last 30 years there, to the point where dams have been exploded and levees broken on purpose by the Chinese government, flooding farmland in order to save cities downstream, mega cities, including cities like Shanghai and Chongqing and Wuhan. All these cities are downstream from this Three Gorges Dam. The last thing I have heard is that there is more rain on the way, and that the Chinese government, by one source, is suggesting that they have acknowledged that the Three Gorges Dam has actually moved a little bit and has been deformed somewhat due to this record flooding. So I think this is something that is still ongoing, and it's really important to keep watch over because it may not be the end of the story. But I do think there is a relation there between what's happening with China and their purchases and what's happening with their state reserves.
But in a nutshell, do you think that would favor more corn or soybean prices?
Well, I think it keeps wheat in the leadership position. We talk a lot about wheat being our leader. I think the wheat and the rice market and the oats market have been the best leaders in the past, and they have been the best leaders this year. The rice just got done making a terrific run to the upside, and that actually ignited the wheat-rice spread to where rice fell to the wheat, and the wheat was able to find quite a bit of short covering. So I like it from a standpoint that between the currencies and what we're facing in our own country with the corn drought still, that I think is still an issue, I think the wheat is still the key to be watching in terms of allowing for more upside in the corn price here in the middle of the summer and going into the late part of the summer.
Yes, you have been talking about the wheat rally for a long time, and you like to analyze for a midterm perspective. So, what are you feeling with the current S&P stocks?
Yeah, this is where the outside markets have had what the professionals would call a reflation trade going, where they're inflating assets, re-inflating them, putting price premium in them, because of the extraordinary amount of stimulus that's going on in the world right now because of the pandemic. The European Union is the latest to push about 2 trillion US dollars into their economy to reflate their economy because of COVID. We here in the United States are settling on what looks to be about another $1 trillion in terms of an economic stimulus package. So we have the S&P 500 within about 50 points of its all-time high. We have the gold within about $50 an ounce of its all-time high made back in 2011. We have the US dollar near it now after this week's trade, its lowest since late 2018. The euro currency at its highest level since late 2018 as well. So this reflation trade has not been hitting the agriculture markets as much as I've wanted. I've wanted this to transmit itself into the agriculture side more, but it has not, I think in part because the trade's expectations that supplies are going to be big in the feed grains, maybe less so in the oil seeds, but big in the feed grains because of the weather. And that's where I would probably say they're getting ahead of themselves given the drought monitor here in the United States.
Yes, I checked some reports about the crop not being so good in Colorado, in Ohio. So do you think we would really have a supply problem in those areas regarding soybeans or corn?
Yeah, you know, the thing that I see, Luis, is where we're at now versus last year. You know, keep in mind the corn yield last year was 167.5 bushels nationally. And yes, we had a terrible flooding issue that probably knocked out some acres, but did it really hurt the yield that much? And when I look at the drought monitor right now, just to go down some key states, west of the Mississippi River, Iowa is at 54% drought. They were at 11% last year this time. Nebraska's 57% drought, 0 last year. Kansas 60%, 0 last year. South Dakota 61%, 0 last year. You've got 4 major states that are 2/3 in drought right now, and they had no drought whatsoever. And USDA is promoting the idea that we have a 178.5 national corn yield. You go east of the Mississippi, Illinois is about the same as last year at 12% drought. Indiana is at 71%, and they were at 11% drought level last year at this time. Ohio is almost 80%, coming in at 78% drought. They had 0 last year at this time. I have a lot of clients in Ohio, and a lot of them in the richest part of the state with the greatest soil fertility are the areas that are the most drought stricken. So it really makes it difficult for me to justify a 178.5 national corn yield when we had 168 roughly last year and absolutely no drought in many of these states. And I know a lot of Chicago traders and colleagues that are analysts are actually putting the corn yield closer to 180. I just can't accept that yet.
And how do you add the fact, we can add the fact that Brazil has a fast second corn harvest underway, so that has also an impact on prices.
Yeah, and I think that's been a liability to the corn market, along with the ethanol prices stalling out here recently. But I would suggest to many people that I talk to that the faster harvests go, the faster they're getting through it, and therefore the yields are not as good as what we had expected. And I think that in the U.S. wheat belt, I think that in the European wheat belt, the Russian wheat belt is still an issue for me, and we still have issues with the Australian dryness along with some other countries. So I think that the short-term issue of the lower Brazilian corn price and what's happening in Argentina with their drought continuing and probably taking away from acreage bases for wheat, these are still factors not in this market yet. Even though we've got this reflation trade going on in the outside markets, the ag fund investor, it seems to me, is almost making the grains the short side of the spreads here. And maybe it has to do with the U.S.-China trade tensions because of this consulate being shut down in Houston. It seems as though the confidence level is very low in agriculture right now, that something new, some black swan that is going to come back in and hurt these markets. So why get long the ag sector, trade the short side of the spread, or stay out of it completely?
Well, I will ask a question for livestock producers, for a question that livestock producers can use. In Brazil, since 2015, we have heard there that every year is the year for livestock, that there will be more profits in the chain. And I read this week a report from Rabobank and saying that the second half of the year would be really strong for poultry producers. How do you assess that?
Yeah, I'd probably be a little bit more dot the I a little bit more and cross the T, and be a little bit more final about it, in terms of, I'm more worried about the third quarter in prices for cattle, especially. I'm not as worried about the hogs. We've talked about how the discount of prices is probably in the market already for the hogs and the pork meat, especially given their low prices at the consumer level. Whereas beef, it's still not enjoying that lower price and that extra demand hit and extra demand bump. And we continue to carry a lot of weight in these cattle that are on the feedlots here in the United States. So I think the third quarter, between the COVID resurgence and how we're going to have to social distance, and how restaurants are starting to see a sag again in demand, I'm more eager to get hedges in place in cattle for the third quarter. I do think the fourth quarter, though, is probably the best scenario for maybe putting in a major low, because the production and supply side should be putting in a major high. I think we would probably be topping in terms of production and supply and slaughter as we get into the fourth quarter. And then that sets us up for the first quarter of 2021 to have some more normal prices, more profitable prices, if you will.
And where are you standing about the US dollar outlook?
Well, the market, and we talked about this last time we got together, the smart money, the big banks, were talking about a continued weakening dollar because of what's happening in the recovery in Europe and what's happening with some good recovery in parts of Asia, and that the U.S. has got a weakening mindset. And that makes sense if we inflate this market again. The biggest issue, though, to me, Luis, is the November election here in the United States. I could see a very big change in the dollar trade if President Trump does not get a second term. In other words, I could see the dollar become quite a safe haven and be bought and appreciate very rapidly if Vice President Biden would win the election.
And we also mentioned in other episodes about the race to the bottom regarding interest rates. But I think as of right now, this is over. There's no room for another interest rate cuts.
No, and I think you bring up a major historical point that I think the listener really needs to think about. And this was in one of the financial newspapers this week, and it makes a lot of sense. And that is, the central banks have given over monetary policy to their governments at this point. The major governments, their Congresses, their legislative branches are now driving monetary policy. And it should be that way given the fact we're in a pandemic. But that changes the whole dynamic of how the bond market and the interest rate markets trade, because governments are now making the decisions, not their, quote, independent central banks.
The clever Mike Zuzolo, am I forgetting something here?
No, just have a great day, Luis, and thanks for having me.